Everybody. Today is Friday, December 7th. I am Andrew Packer, editor at Newsmax, welcoming all of you to our monthly financial BrainTrust call. This month, it's my pleasure to host a roundtable with most of our BrainTrust members, where we will be sharing our top investment themes for 2013. A few folks couldn't make it today, but did briefly send me some ideas to share, which I'll do between some of our folks on the call today. If we have time at the end, we can discuss some of these ideas in more detail. Please remember that these calls are being recorded. Those who are not participating in this month's call should put their phones on mute to minimize background noise. And on our conference call system, that can be done by hitting *6. As always, please speak clearly and say your name when you first start speaking. So out of the folks on the call that we have so far, let's start with David Nelson. David.
Well, Andrew, if this is Elaine, if I could just jump in here, and one more reminder for everyone on the call, please try to avoid speaking over each other when it makes it difficult to do the transcription to be able to understand what's been said. So if we could try to keep that to a minimum, that would be appreciated. Okay?
All right, thanks.
I'm done.
Yeah, great. All right, David?
Andrew, thanks for having me on the call. It's great to be on again. I guess for today's call, and we're talking about investment themes for, 2013. And, you have to have a view on the fiscal cliff when you're talking about 2013. And as negotiations go on in Washington, I've been on record saying that I do believe that there'll be a deal, and I don't believe that Congress is willing to commit political suicide. And if a deal is structured, then of course my bullish view is intact, and I think we'll see market highs, sometime next year. But coming into this call, I said to myself, what if I'm wrong? Then there's certainly, at the very least, there'll be a lot of turmoil in the markets, and investors will be looking, for some place to hide. And actually, that's what I'm going to bring up today is a stock that I think is going to grow through next year, regardless of whether the cliff comes to be or turns into a slope. And it trades on the New York Stock Exchange. The symbol is SCI. It is Service Corp International. Pretty old company. It's been around for a long time. If many of you may not know it, but this was one of the premier growth stocks, up until about 2000. It was meteoric almost through the 90s. And, I'll use a really bad pun here. People are just dying to get into this name. And if you haven't guessed it, SCI Corp is in the cemetery and funeral business. It got as high as the mid-40s in 2000, and then just really collapsed under its own weight. Management made a lot of strategic mistakes. They overpaid for a lot of acquisitions. And but in some ways, you have to think of it as really, kind of the ultimate staple stock. We can talk all we want about how, companies that sell toilet paper are impervious to an economic slowdown, or maybe companies like Coke. Everybody seems to want a Coke, but in the end, everybody dies and utilizes the services of a company like Service Corp, which has been consolidating the industry for quite some time. So if any of you have a chance, take a look at a 20-year chart. You'll see the collapse that it had very quickly from 2000, and then settled literally as low as 3. And it's been on a slow, steady march upward, over the last, really over the last decade. It's currently, just hovering around 14 or thereabouts. In the last several years, they've done very well, but in particular, the last 8 quarters, they have beaten the numbers every single quarter. Now, I'll grant you that this is a company that, it's a little bit expensive. It trades at around 16 times forward numbers, but those numbers are very, very doable. And while free cash flow is going to be negative over the next year, it is because of some of the expansion that they are in fact doing. The industry's kind of changed. It's not just about selling a cemetery plot or booking a funeral. In many ways, the demographics have changed. People are actually buying. As they get older, they start thinking about their funeral, and they're actually prepaying this. And in some ways, it's more than just booking the funeral home. They're booking in some ways a legacy. I would encourage you, go to their website and look at some of the services that are out there. you can see that for many people, a funeral is almost an event. I remember even just that was a number of years ago, when my mom passed away, and I had never booked a funeral, and I was just inundated with, what do you do now? And we went to a funeral home that was owned by Service Corp, and it was a very elaborate experience. Did a very good job. But what I learned about the funeral business is it's actually an all-encompassing event. They take care of everything, and I mean everything. And they took care of everything from, the cemetery plot, which we hadn't procured, to the funeral, which actually in my case was pretty elaborate, the after dinner, the cards, all the things. We've all been to funerals, and we've seen what these events look like. But I've been in and out of this name over the last 5 years, and I can tell you unequivocally, as a portfolio manager, I have been overtrading this name. If all I did was buy it like I did in 2003 and just stuck with it, I would have made a lot more money for my clients. I've left a lot of money on the table here. We've been in it again. They've announced another great quarter in the last quarter, and we think it will just continue to do well. I know many of you will probably ask, what's my target on this name? I don't have a target. I think it can support a 16 forward multiple, and I expect the stock to just drift higher as the years go on. And with that, I'll take any questions.
All right. Thanks, David. It's certainly an interesting play, and certainly one that's probably off the radar for most people, so appreciate that. Next up, I believe Tom Hutchinson was on the line. Tom?
Yes. I like, basically, in general, I like healthcare, and more specifically, biotech. I think that you couldn't have a better demographic trend. The world is aging, the United States and the world is aging at a clip never before seen. Obviously, older people use a lot more health care. That's the way we're built. The elderly population of the world, according to estimates, in the next few years will outnumber the young for the first time in human history. In this country, there's about 10,000 people retiring every day and will for the next 19 years. In the United States, about a third of the population, close to it, is 50 and older. The 65 and older demographic is growing 4 times faster than the overall population. So this aging trend is real, and it's huge. At the same time, you have the whole emerging market phenomenon. Rising middle classes, higher discretionary incomes. Obviously, there's a huge demand for more and better health care. So that's going to add to it as well. In addition, the group is defensive. I mean, look, nobody knows what's going to happen with this fiscal cliff stuff, with Europe, with Iran, China, on and on. There's a lot of uncertainty. Obviously, healthcare is a defensive industry. People are going to get sick no matter what. So it has that going for it. Also, healthcare is also one of the few industries that benefits from Obama's reelection. I mean, although there's some near-term costs involved, at the end of the day, Obamacare is going to go through, and there's going to be about 30 million additional customers buying drugs and healthcare products. Now, I like biotech in particular. This is the cutting edge of the innovation for the industry, creating new drugs all the time. It sort of combines technology with healthcare. The problem, though, with a lot of these biotech companies, when you pick an individual company, you're sort of gambling on whether they get approvals or not, or what happens in a given year. It's sort of like Russian roulette. Even if you really know the industry and the product inside out, it's still not good enough. You're still taking a big gamble. So the way to play this, I think an ETF works really well in this particular space. And that's what I like. The iShares NASDAQ Biotech Index Fund, symbol IBB. The fund is it's the largest. It has about 121 biotech firms in the portfolio. And more than 21% of the portfolio is actually small and micro-cap companies that are really, coming out with some new innovations, but are much too treacherous to buy yourself. It has the broadest number of holdings, and it's the most actively traded of all such funds. The track record's been excellent. It's delivered a 10-year average annual return of 10%, 3-year average annual return 20%. Year-to-date, it's up 33%. But I think it's going to continue to do well in the years ahead. Also of note, in 2008, the fund was only down 12%. Compared to, I forget what it is, 36 or 38% for the general market. The positions it has, the biggest holdings are familiar names: Amgen, Gilead, Alexion, but also it has a huge presence in the smaller names. And I think given the demographic trend, the defensive, the uncertain nature of the market, I think this is a great space to be in, and the ETF's a great way to play it.
All right, thanks, Tom. Interesting to hear you go for something that's not as income-oriented as you usually have in your newsletter.
Nobody likes the income-oriented, nobody ever did.
Right. All right, I believe we had Sean Hyman also on the line. Sean?
Yes, I want to send around just my notes real quick just so people can see that. So feel free to check that out in your inbox because I'm kind of visual, so there's a chart in there. I agree that it's hard to say what this whole fiscal cliff thing is going to bring. So my opinion is to go into things at this point that you believe will still prosper and be good long-term bets, if you will, no matter what the fiscal cliff holds in the near term. And I believe, oil is trading at a discount. I believe oil is going to rise higher in 2013. I believe ultimately global economy is going to expand in 2013, barring something just massive out of the fiscal cliff. And one of the bases for that is, but we've seen commodities build a floor and turn upward again. They built a floor through the June through September period, and I believe that's a lot of increase in renewed demand coming on from the global economy, and we've seen an upturn there. We've also seen an upturn in Indian stocks that are leading the way out, and China's stocks are finally starting to respond, and also some of their data starting to turn around as well. So I believe oil will end up heading higher, and I believe there's oil companies that will benefit from that. One of the ones I like the most is ENI, which is ticker symbol E. ENI is $84 billion oil and natural gas company, and I believe they've got just great fundamentals. Trailing PE of 8.56, forward PE in the 9s. So it's cheap relative to its earnings. It's cheap relative to its price to book at 1.12, which equates to about $42 a share, and it's trading just over $46 a share right now. The company earned over $39 billion last year, EBITDA, and they've got almost $8 billion in cash on their books. Their debt is about a third of their market cap as well, so it's at respectable levels as well. But the thing is, even though it's a great fundamental sound company, it hasn't moved anywhere in about 4 years now. ENI had traded up for years, and you can see this on this 10-year chart that I sent through the Word doc. Went all the way up to about 85, and then during the whole global collapse, basically went all the way down to about 30 in a three-wave correction, and that's corrections tend to unfold in three waves, and so that $30 price target, I believe, that $30 area, I believe, was the end of that third wave in the floor. And after that, either stocks will tend to build a base sideways or begin its next uptrend. In this case, it built a very long sideways base, a 4-year sideways base. And the reason why I think that now is the time to get into it is because of a few things. One, you'll see in the chart above that there's a huge spike in volume. Almost 20 million shares traded in a week, which is far more than the say 3 to 5 million that it normally trades in any given week. I believe that was a point of ultimate maximum pessimism, where most of the sellers who were pessimistic on the stock got washed out, sold their shares, and after that allowed the company to start building a base or building a higher low after that, and that's what we saw in the months that transpired after that. And so I believe we're about to see a turnaround in ENI technically on the charts. I believe we're past the point of maximum pessimism. Also, for those that follow Elliott Wave, normally sideways ranges will have about 5 passes back and forth. They call it an ABCDE formation, and we have now had 5 passes back and forth over this 4-year span. That final higher low that's in mid-2012 is the E, and then if that's the case, then we should begin to head higher from here. So once we see about 50 to 55 push through, that's when a lot more people will be alerted to this and hop on board. I've got a $75 price target on it, and where I get that from is just the technical pattern on the charts. It's basically a rectangular pattern that is there on the that's transpired over the last 4 years. And what you can do is you take the width of that pattern, which is $20 per share, from 35 to 55 per share, and then the top of the pattern is at 55, and so you add the $20 to the 55, and that's the minimum price target that you get from that pattern, which would be $75 a share. Now, in the past, it took 3 years to go from 55 to 75, but we've been in such a long base for so long that technically what tends to happen more times than not is the breakouts from these very elongated bases are usually fairly swift. And so I believe what it accomplished formerly in 3 years will happen in minimally 2, could be even sooner. So I'm bullish on ENI. I think it's a buy right now today, and I think that over the next 12 to 24 months we'll see it hit its $75 price target, and still really honestly even at that point still be at very reasonable, respectable PE levels even then. So that's my pick, ENI.
Thanks, John. Pretty interesting, especially also being, sort of, a big, government supported somewhat oil company out of Italy, which has certainly been kind of sold off as well, just with the broad stock market there. While we're on that note, I do have comments from Bob Wiedemer, and his prediction for 2013 is that natural gas will hit $5. And as Bob has been writing for this month's FIR, he's been pointing out a few different things. First, he points out that in the words of the CEO of ExxonMobil, Rex Tillerson, who paid a high price for big shale gas company XTO, quote, "We're losing our shirts. Nobody's making money on natural gas at $3 a thousand cubic feet." At the very least, Bob feels natural gas needs to be priced at 5 or 6 to make the shale wells that are so popular in the news right now profitable. And that's also assuming cheap capital. That's particularly important because so many big companies, including foreign ones, have bought a lot of shale land off the natural gas play over the past few years, and these companies have had to eventually write down their investments by 25 to 50% just a few years later. The biggest recent example he gives of that is BHP Billiton, the big Australian mining company. The other interesting thing that Bob notes that could help fuel natural gas's price rising to $5 is that in response to these, unprofitable prices right now, gas drillers are finally cutting back on drilling, just as veteran oilman T. Boone Pickens and some others have been urging. In the past year, the number of rigs drilling for natural gas has plummeted by almost 50%. One of the things Bob points out is that Chesapeake Energy, which is the second largest gas producer in the country right now and was a big leader during the boom in natural gas and shale extraction, has basically shut down its Fort Worth, Texas operations, which is also kind of where the first really big shale play was. So that kind of goes in, I think, a little bit with what Sean's been commenting a bit too about oil being at a discount. So is natural gas as well. So that is from Bob Weimer. Moving along, do we have Jared on the line?
Hello, this is Jared.
Yeah, go for it.
Okay, my recommendation is storage units. They've been really booming the last since the recession. I mean, people are downsizing their houses. People are using them for storing when they move. Businesses use them for storing paperwork and inventory, all kinds of activity. So they've been doing very, very well, and I expect them to continue to do well. My pick is Extra Storage Space, which is symbol, here it is, EXR. They're one of the larger players with something like $3.7 billion in capitalization. And this, frankly, if you look at their chart, this is frankly one of the best performing stocks I've seen. In the last year and a half, they're up over 60%. In the last 3 years, they're up over 130. I'm sorry, last 2 years, they're up over 133%. And I see no slacking in this trend that people are going to be downsizing homes, need places to store their extra stuff as people get older. They, of course, move to smaller places. And as has been mentioned previously, we have a very rapidly aging population. So that's my recommendation. The only real negative about them is their PE is high at 36. However, I don't see any reason for the trend to change. If you look at the trend for 5 years, it's just up, up, up. It's one of the best performing stocks I've seen. And again, in the last year and a half, it's up 60%. I would expect it to do the same thing in the next year and a half.
All right. Thanks, Jared. It's interesting.
EXR.
EXR, great. Interesting to hear a lot of folks so far mentioning demographic trends and their analysis for 2013. I believe we have David Skorica on the line with us. Made it on the call, David? Oh, he just sent me an email, so I guess he's still getting set up for the call.
No, I'm here. Yeah. Sorry, I just had to
unmute.
Okay. I had to unmute the phone. That was all.
Great. You ready?
Yeah.
Okay, cool.
So basically, I have two plays, and I guess I'm with Sean Hyman in that I'm kind of into these maximum pessimism, contrarian type investments. And as I talked about, I think on the BrainTrust Trust call starting in June, I've been really bullish on Europe. And actually, if you look at the European market since June, they've actually performed very well. And I think they're in the classic bottoming phase where the news has continued to get worse in the last few months. The downgrading of growth or showing Europe still be in recession next year, and the arguing over the restructuring the Greek debt. But the markets have actually stabilized, are nowhere near their June lows. And if you actually look at many of the European ETFs, like EWI, which is the Italian ETF, or just the markets themselves, they're actually very close to breaking out to the upside. So I think that we could be getting close to some kind of break. I still think it might take a little while longer. So my pick on the European side, and if you remember back in the summer I picked HL Toy, which is actually roughly doubled since we picked it. And my my new HL Toy is Pris from Toro Marciani's. That's it's the largest media company in Spain. It trades on New York PS. They have a $3.5 billion in revenue and only a $100 market cap. Of course, like a lot of media companies, they're pretty heavily leveraged. They have a large debt, but they converted a lot of this debt to equity this past summer. I kind of like a media company because, they do a lot of television shows. They cover a lot of sports like soccer in Spain. And, obviously with people having less disposable income and with, a recession, they're actually going to spend more time sitting in front of their TV. Obviously advertising rates will be hit a bit, but the stock has come from $13 in early 2011 to $1.45 now. And I think if you get a stabilization in the European economy, which I think will happen over the second half of 2013, this can be, again, like HL Toy, go to $3 to $4. And my other pick is Forbes and Manhattan Coal, FMC on Toronto. It doesn't have a U.S. listing. They have a coal property in South Africa, and their revenues and profits are up 16 and 11% year over year. Their cash position's up about 70 to 80% year over year, but because of coal prices going down and where the commodities markets are, the stock has gone from $4 to $5 to about 50, 60 cents. And the nice thing about them being in South Africa is they sell the coal mostly within Africa, and so there you don't have to worry about, shifts to clean energy or the whatnot, because Africa is growing like most emerging markets, and they just need a source for energy, so they're not adverse to coal. They did have a labor dispute, but they've just solved that, so that's another positive for the company. So I like, as kind of two stocks that are down 70, 80% from their highs, I like Pris, and I like Forbes and Manhattan Coal.
What were the symbols?
Pris is PRIS on York, and Forbes and Manhattan Coal is FMC on Toronto. It has a Toronto listing, not a New York listing, but most brokers should be able to trade something on Toronto.
David, this is Ashish here. I had a question on the FMC. Is there going to be any consequence of the currency if it's all South Africa and related to Africa? How does currency play into this? Or does
a currency devaluation would probably help because, of course, coal is priced in U.S. dollars, so they would get the same equivalent U.S. dollars back for the selling of the coal. But on the other hand, if the currency was devalued by 20 or 30% or 10 or 20%, which the rand has done at times, your cost of production within South Africa will actually go down. So I don't know what you're saying currency. Do you think the rand's going to be valued higher or valued lower? The history of the rand the last few years is usually it's devalued to the downside. So that would actually help the expense side of the company.
And FMC is U.S. dollar functional? In terms of reporting, so how will that... I'm trying to evaluate the effect of currency on stock price.
They're Canadian dollar functional in terms of reporting because it's a Canadian-listed company in Toronto.
Okay.
So, like I said, if the currency devalues in South Africa, it would probably help their bottom line because the expenses in Canadian dollar terms are going to go down, where the revenues in U.S./Canadian dollars will probably stay stable because that's where you're going to sell the coal on the spot market in the equivalent of U.S. and Canadian dollars. Now, if the Canadian dollar were to run up big time against the U.S. dollar, and I'm looking for a mild valuation higher than the Canadian dollar, like the Canadian dollar going to 105 this year or something like that, which really wouldn't affect the bottom line too much. Now, if the Canadian dollar goes up a lot to 110 or 120, yeah, that would probably hinder because you got to convert back to Canadian dollars. But again, I'm not really foreseeing that. I'm seeing that the Canadian dollar maybe sees a 5 to 6% gain against the U.S. dollar, which won't hurt their bottom line that much. And of course, if the rand devalues more than that, that will really, really help the bottom line even more.
I agree with your currency valuation stuff. I'm Canadian, so I agree with the Canadian aspect of it. Okay, great. Thanks.
And the company, because the way it's run by a group out in Toronto who really doesn't believe in huge amounts of debt financing. So the company has a small amount of debt, but it's mostly been funded by equity financing. So you don't have to worry about debt as well. And again, another positive aspect, that's my last point, is because it does operate in South Africa, but it's Canadian. If they do get a debt financing, they can finance at Canadian rates. They can finance at 2-3%, not finance at like 6 or 7%.
Okay, great. Thanks.
All right, very interesting plays you have there. Thanks, David, for your contribution. About halfway through the hour now. Is there anyone else who's joined our call since we started that hasn't had the chance to contribute yet?
Hey, Andrew, it's David Nelson. I was wondering if I could ask Tom Hutchinson a question.
Sure thing.
Sure.
Hey, Tom, I guess my question is, I love the pick, and I do believe in the biotech space, and I think you're approaching it from the right end because, I've been on the wrong side of, biotechs in the past, and they are binary events. Either they hit a home run or they strike out. But you talk about, the makeup of the ETF. Now, do we know, the top 10 holdings are going to probably be, some of the biggest, biotechs out there, I would think. What percentage is that of the overall, and how much of an impact do these smaller, more revolutionary companies really have?
Well, the smaller companies are about a quarter of the portfolio. The top 10 is probably between 50 and 60% of the portfolio. So it's going to move a lot with the top 10. But again, with them, you're not gambling on any one of them. And you also have exposure to the smaller space, which is tough to get.
Yeah, I guess there's nobody makes an ETF that I know of. Does anybody make an ETF that is an equal-weighted version of this?
Yeah, there are a couple.
Really? Okay.
I forget the symbol. I can get it to you later.
Okay.
But, yeah, I think there's one with equally weighted of the top 25 of the biotech picks.
I haven't done the work, but one of the guys at my firm has done a lot of correlation work, and what I like about your pick is it, even though equities are very much correlated with each other, biotech seems to fall outside that mainframe, and hence is probably why it on a relative basis performed so well in 2008. So it does deserve a spot in a portfolio, I think.
Yeah, and of all the other ETFs, this one really had the best performance. It's the most liquid. It's been around the longest.
Thank you.
Welcome.
Okay, anyone else who would like to contribute who hasn't had the chance to yet?
Andrew, this is Mike Carr. If I can provide a pick for 2013.
Please do.
I agree with everyone talking about the demographic trend, and I think that's very important to follow. As Tom pointed out, as people age, they break down. Biotech is a great way to play the breakdown in health. David pointed out that ultimately people not only break down, but they die, and you got to bury them and get rid of them. And in the end, in order for the economy to move on, those people get replaced. So I looked at the demographics of things rather than people, and I found that things are aging just as rapidly as people are. And the replacement cycle could offer an investment opportunity there as well. So with the new normal and all the deleveraging that's been going on in household balance sheets, a number of people have deferred buying automobiles. And at the end of 2011, the National Automobile Dealer Association showed the average age of cars and trucks on the nation's roads was about 11 and a half years, an all-time high. While cars and trucks do last longer nowadays, they are wearing out and they're going to need to be replaced. So rather than trying to figure out what consumer tastes are going to be and which automaker to buy or whether they're going to buy new or used, I looked at the auto dealers, which as a group are relatively undervalued and have been among the strongest performers here in the past 6 weeks to 3 month period. And at the top of the list of auto dealers, I found Sonic Automotive, SAH. They operate 119 dealers in 15 states. They have 30 different brands, and the stock's trading at a PE ratio of about 15. Earnings haven't grown at all in the last 5 years, but they're looking to go forward at about a 20% earnings per share growth rate. If the stock had a PE ratio of 20, giving it a PEG ratio of 1 in fair value, the stock would be worth about 33. It's trading at about 19, so there's significant upside over the next year. On a short-term basis, a nearby target in the next 3 to 6 months would be 23 a share, which still offers a potential gain of about 20% in the next 3 to 6 months. So Sonic Automotive, SAH, is another play on this demographic trend of aging and replacement. That's it.
All right, thanks, Mike. It's pretty interesting that we've had, nearly everybody on this call so far mentioned sort of these demographics. People getting older, people having to die, that sort of thing. I was also looking at demographics, but I also sort of went a little more global. That's kind of led to my investment idea for 2013, which plays off of global growth increase. According to the International Monetary Fund, the world's population is expected to increase to 9.1 billion by 2050. And that's actually, indicating that the population growth is slowing. And that by 2030, developed countries like the United States, the EU, and Japan will all have negative growth rates, even accounting for, immigration, that sort of thing. So from an investment standpoint, one of the interesting things that I like are commodities, specifically the agricultural commodities. And there's a lot of different ways to play this, and some commodities will do much better than others over the course of a year. You can get a lot of unexpected droughts, things like that. So the area that I kind of like, and I think really ties in with this whole idea of increased food production, which is expected to increase by about 70% from its current levels by 2050, is with fertilizer. Obviously, being able to take somewhat productive land, being able to increase its productivity, being able to grow more crops in the same amount of space or in less time, or to grow larger, healthier crops, very important thing. And fertilizer is an important component of that. And there's a pretty fair number of different companies that I like, but I keep coming back to Terra Nitrogen, ticker TNH. It's LP, so it's a limited partnership. Gives it a nice income boost, which I think a lot of people are still going to need in 2013 with these ultra-low interest rates that we have everywhere. Current PE is about 13. Current yield's about 7.7%, which is, pretty sizable. Makes up for a lot of the lost income from other typical investments. The growth numbers are pretty good. I've had a slight decline in revenue growth recently, but more importantly, they have these fantastic profit margins. The most recent numbers was about a 39% profit margin and a nearly 70% operating margin. So I still like this fertilizer space. I think it's going to be a great long-term play on sort of the growing side of the demographics rather than sort of the negative side that we've been talking about so far with people aging, dying off, that sort of thing. So that is my investment outlook and view for 2013. Anyone else on the call who has an idea that they'd like to share that hasn't yet? Otherwise, we can open things up for a bit of a roundtable, discuss some ideas a bit more.
Jared here again. I just want to also recommend gold. I like physical gold a lot. The price, of course, is down from the peak about a year and a half ago, which was about $1,900 an ounce, and it's currently about $1,700 an ounce. The reason I really recommend it is the enormous monetary inflation occurring in the U.S., Europe, even to some extent in China. And I think that you're going to see a breakthrough in gold in the next 6 months. I believe will be up for the year at least 20% by this time next year. And over a period of 2 or 3 years, I would not be surprised if you see a 50% increase.
Hey, Garrett, it's Tom Hutchinson. I just have a quick question about that.
Yeah.
I'm not a real gold expert. I really focus on income-oriented investments. But I agree with you long term. With what's happening with the currency and the Fed, gold looks like a great play. So if you're going to lock something away in a safe for 5 years and come back, it's a good thing to pick. But in the next 6 to 12 months, it seems to me that what I've seen gold really move on was a combination of a lower dollar index and solid growth internationally. And those are the two things that I've seen drive it. I don't see either of those things happening. Or good global growth. I mean, it may, but I don't see those trends. Am I wrong, or what's going to make gold move higher in the next 6 months?
Firstly, in the U.S. now, you're seeing the money supply expand. If you look at the figures, and I think you'll continue to see that with all the deficit financing going on. So I think that's one factor. The third thing, which you didn't mention, is gold really moves really sharply on really negative news like war. And I was just reading this morning that U.S. forces and aircraft carriers now off the coast of Syria, and also forces are massing on the border. So I think you're going to see expanded warfare in the Middle East. I don't see any easy resolution with what's going on in Egypt, with what's going on in Gaza, Syria. I mean, you could see a major explosion in violence. Unfortunately, I think you're going to see that happening to a large extent. And the U.S. is now moving forces also into Africa, in addition to the other wars it's involved in Afghanistan and there's a possibility of conflict with Iran. I mean, I think you see the world like as a tinderbox, like you haven't seen for maybe since before World War II. And as a consequence, unfortunately, I think you're going to see an explosion of violence, and gold moves on that type of news. And again, the other factor, which I mentioned, is you're seeing a big expansion in money supply in the U.S. and in Europe. The unlimited purchase, backing of banks now in Europe, unlimited purchase of bonds in the U.S. That's highly inflationary.
This is David Nelson. I'd like to chime in on Tom's comments as well. While I believe that gold can move on some of these events, I think Tom's point is well taken because the highest correlation is inverse to the dollar, and it has been. Even you look at back in 2008, it wasn't much of a buffer for a while there. Through some pretty negative events, and I think it's much more important the direction of the dollar. And for the dollar, in the end, as weak as our currency is because of the monetary expansion that we have here in this country, in the end, it's a relative experience. A good portion of the rest of the world is doing much the same thing. So I think your theme works longer term, but I'm concerned really over the next 6 months because I don't see, even though Europe has rallied pretty hard, I question their currency relative to ours because I don't know how you can have really support a common currency without a common government.
Yeah, well, I agree with their currency. I just think the U.S. Financial position is going to continue to deteriorate, and that the money supply is, after shrinking, it's now increasing, and that's inflationary.
Can I just make a quick comment on that?
Sure.
Yeah, if you look at the chart of the U.S. dollar index long term, like over several years, I mean, you see that year and a half long rally upward in the dollar, but then you see it break that trend line in about August, September. Now it's come back up to retest the underside of that trend line, so it's still in that transition really of turning over and becoming more obvious. But from a technical perspective, it's already breaking down. So that's one of the reasons to be bullish on gold. The other is because gold has built such a base for the past year and a half in between that 1,500 to 1,700 area that I believe it's just building that base to head higher from, and its long-term technicals are perking up quite a bit on MACD, RSI, things of that sort. On the fundamental side, when you look at things like the European bond yields have come down quite a bit. The European markets have rallied up quite a bit, even despite a lot of the bad news. The euro has held up quite well despite the news and things of that sort, and actually has bounced back quite a bit. So I think there's a pretty big case building right now for the next phase of the dollar decline that I believe has already begun. It's just it hasn't become obvious to most, and it won't until probably the next month or two or three. But I think all of that's going to be bullish for gold, precious metals, and even industrial metals in the months ahead.
This is Ashish. I'd like to also put in my thoughts on that, and I'm agreeing with the uptrend in gold. The other aspect, when we talk about inflation, we're also having to consider global inflation, and my anticipation is you will start seeing China begin to creep up in terms of food inflation and inflation within China, and India will go the same way, and we will see another surge of inflation coming out of Asia more than the U.S. itself, and that will again lead to more buying of gold. So I've been a long-term gold buyer and continue to do so at these rates.
Hey guys, Andrew here. As long as we're talking gold, I'd like to get your views on some of the other precious metals. There's been the occasional sort of news report about, how Congress can get around the fiscal cliff, the Treasury can issue some kind of platinum coin and give it, $1 trillion value to avoid the debt ceiling, all that sort of thing. Personally, I've always liked silver. I think there's a lot more potential percentage upside relative to gold, so just wanted to throw that out there, get other people's views on that.
Yeah, this is Dave Skarica. The two things on gold. I think the problem with looking at this strong gold, weak dollar kind of trade is that all the paper currencies right now are basically garbage. So they're all devaluing. So they could stay equal to each other. And I agree with Sean. I actually think you're going to see relative weakness of the dollar compared to the euro. And I think what no one really points out is Europe's doing austerity. The United States, and on the political side, I don't really see any difference between the posturing between the two parties and then the fact that Europe can't get along. I think that each system is equally dysfunctional. That's my opinion. I think that we tend to criticize Europe too much because there's a whole bunch of different countries, but nothing really getting done in the U.S. as well. But and in terms of gold, like I said, they're all devaluing, so that's really what's happened in the last 2 or 3 years. Like the U.S. dollar has just kind of sat around the 80 level. It's kind of sat at par with the Australian dollar and Canadian dollar, and around this 120 to 140 area against the euro, but gold has gone from 1,000 to 1,600. So it's really just a debasement of paper currencies. And I think after you get through this month, and a lot of the big hedge fund guys, which are long gold and getting some redemptions, so they have to sell their GLD or whatever, I think you'll start seeing the next move upwards. And I agree with Andrew. I actually prefer silver because I think that, a move for a double in gold, you'd have to go to over 3,000, where a double in silver would take you to 60, which is probably a lot easier attainable. And, I'm a little biased here, but I prefer the gold equities and really the small gold stocks, the smaller kind of junior companies that are maybe going into production and that sort of thing, because they've really been beaten up in the last year over the fears of the European kind of banking crisis. So I think the risk reward is probably better in them right now than it is in the actual precious metal itself. And in terms of other precious metals, I think there's some small graphite is really interesting, and some of the kind of rare earth metals are really interesting. They were frothy about a year or two ago, but they've come off a lot, and they're very strategic, and China produces most of them, and you're seeing production around the world increase in the rest of in those metals because we have to get away being dependent on China. And China at some point is going to stop exporting them because they are strategic metals.
Hey, Dave, this is Tom. I just have a quick question. Do you see the relative valuation of the dollar as compared to other currencies less and less relevant going forward when considering the price of gold?
Yeah, I think it already has been. I think when the euro crisis would get really bad, gold would actually rally, even though the dollar would be strong as well. So I think you're already seeing that. My opinion is that you're going to see the fruition of the European austerity probably in a year or two, and if they can't come to some kind of big decision on taxes and spending in the U.S., you'll still be running $1 trillion deficit in the U.S., and the U.S. will probably have a higher deficit as a percentage of GDP than Greece and Spain and all of the big countries, and that's when you can see the real relative weakness of the dollar kind of kick in. So I think if there's ever a run on the dollar, that's going to cause gold to go crazy, but I think it's already happened. It's essentially the last couple of years, the shift has gone from gold being a contrary dollar play to being basically a contrary paper currency play. And the only country I see right now even saying that they're open to having a stronger currency is South Korea, and their politicians there in their election are all basically saying they don't want to devalue. But everyone else, the Swiss basically linked their currency to the euro. Every time the currency gets too strong in Australia and Canada, they Australia's cutting rates right now. Those two countries also try to devalue somewhat. So I think it's just an anti-paper currency play right now.
This is Jared. I wanted to chime in on the question of gold versus other precious metals. The reality is that silver and platinum are like 80% of the demand is industrial. If you have a slowing global economy, demand will slow. Now, I think they'll continue, at least silver will continue to move upward somewhat. It's been called sometimes the poor man's gold. So I think you'll see increased monetary demand for silver, and if you have some economic recovery, that'll push it up. But I've heard this argument that silver is underpriced for many years, at least 10 years, and could explode upwards. And indeed, it did go up a lot about 3-4 years ago. But I think gold is a much better bet. It's much more the demand is monetary for gold, and gold is like the premier metal for pretty much any investor. So I think although silver is okay, the gold is to be preferred. I think gold will continue to do as well or better than silver. Platinum, again, mostly industrial demand, relatively unknown, not nearly as a very, very tiny investment market in platinum. So with barring industrial demand, I don't really see platinum going up a lot. It's now priced below gold, which is indication of very weak demand for platinum. So, I think that'll go up some too, but the gold is much better. And I also like looking at rare earths. I recommended them, I guess it was about 2.5 years ago, and the next year, some of the ones I recommended were actually up sixfold. They since crashed. The argument can be made again that you're at the sort of the bottom for rare earths. They're a very risky investment, though, because again you have to pretty much invest in the companies, not in the substance itself. So the rare earths could go up, and the companies that basically the stocks that are represented have the rare earth mining stocks could go down. So it's very risky. China does have most of it. I think you might see the emergence of some new companies in the U.S. and other parts of the world to challenge China's near monopoly on these rare earths because they are strategic. So I think they're interesting, but I don't really have a good recommendation of a way to invest in them right at the moment. One of the biggest non-China producers is Molycorp. I think it's MCP, and the stock has just been really trashed the last few years, and so I don't really have a good suggestion on how you could invest in them, although I think the possibility is there if you could find the right company.
The NCP would be a pretty good kind of like pessimism play, if you ask me as well. I like that deal a lot.
All right, interesting pick on gold there and some of the precious metals. Did want to kind of before we close out just share James Davidson's views. He did send me sort of a one-liner yesterday. James writes, my prediction for 2013 is that the recession, quote, comes out of the closet. Since we've all been kind of looking at sort of the positives, that sort of thing, I did kind of want to end with, what are the potential negatives and things we should be looking to protect ourselves in 2013?
This is Jared again. I think we're going to see a renewal of recession in 2013 in the U.S. We're going to see Obamacare taxes hitting big time. I think whatever deal is struck on the fiscal cliff will still mean higher taxes. You're seeing state taxes and fees going through the roof. In addition to the fiscal cliff, you have what's been called the regulatory cliff. Some 63 Obama regulations already enacted that will cost the economy over $100